This is your technical update from the LMAX Exchange Research and Analytics Desk for Tuesday, March 1st, 2016. Euro dollar. So the pressure remains on the downside following this latest breakdown below 110, and the market is now focused on a retest of the key 2016 base from early January at 107.11. This level guards against more critical support further down from December at 105.21. At this point, look for any rallies to now be very well capped towards the 111 area, while ultimately only back above 112 would really take the immediate pressure off the downside. Sterling dollar. So cable seeing a bit of a correction in early Tuesday trade, though ultimately the pressure remains on the downside while the market holds below some previous support at 140.80, that previous 7-year base. At this point, the focus now is for any rallies to be well capped ahead of the next major downside extension to test the 2009 multi-year base and that measured move objective at 135. Both of those levels sort of coincide. The measured move objective and the 2009 base coincide at 135. At this point, ultimately, only back above the 142 area would really take the immediate pressure off the downside. Dollar yen. So dollar yen has done a good job consolidating above the recent multi-month low at 110.98, though any rallies continue to be very well capped, and while the market holds below 116, some previous support, the structure favors additional downside below 110.98, potentially exposing the next major downside extension all the way into the 107 area further down. At this point, only back above 116 would take the immediate pressure off the downside. Euro Swiss. So Euro Swiss has seen some intense setbacks over the past several days, with the market pulling back from multi-month highs at 112. At this point, key support now comes in by multi-week range lows at 107.15, and only back below this level would really compromise the broader recovery outlook for Euro Swiss. So despite these latest setbacks, the structure is still constructive, and the market is going to be looking to put in a higher low ahead of the next major upside extension. Again, only back below 107.15 would compromise that constructive outlook for Euro Swiss. Aussie dollar. So Aussie has done a good job of rallying out from the recent multi-year lows at 68.27. The rallies have now been very well capped into 72.65, or just ahead of 72.65, which represents a key 78.6 fib retracement. At this point, only back above that level would really compromise the immediate bearish outlook, with the market now looking like it wants to carve out a lower top ahead of a bearish resumption back towards 68.27. But ultimately, it'll take a break back above 73.85 to really put the pressure on the top side and take the pressure off of the downside in this market. Dollar CAD. So dollar CAD has been correcting over the past several days out from those lower from those 146.90 near 13-year highs, and at this point the market is coming into some critical support in the form of that previous resistance going back to September of 2015 at 134.57. Don't look for any setbacks below 134.57 towards 134 to be very well supported, with this market seen putting in some form of a medium-term higher low ahead of the next major upside extension. Really only a close below 134 would compromise the prospect for a more immediate higher low and bullish resumption. But ultimately, if we look back at this chart, it would take a break back below 128.30. That's the low that we saw back in October of 2015 to negate the highly constructive outlook for dollar CAD. So while we could see some more weakness if it extends below 134.57, this wouldn't negate the overall constructive outlook for the market, and the market should be looking to put in a higher low over the coming sessions. The one bearish development for dollar CAD in recent trade has been that breakdown below some key rising trendline support off the May 2015 low. But again, the overall structure remains highly constructive while the market holds above the 28.30 area. Kiwi dollar. So Kiwi has been well capped into rallies, with the market adhering to a broader downtrend, and although we've seen some consolidation over the past several months, any rally should continue to be very well capped in favor of the next major downside extension below recent lows that we saw at 63.47. At this point, key initial support comes in at 65.46, and a break below there will do a good job of confirming this bias and accelerating declines. At this point, key resistance comes in at 67.75, but ultimately a break back above 69 would be required to take the pressure off the downside and force a potential shift in the structure. SPX 500. So the S&P 500 has done a good job rallying out from 1808 lows, those multi-month lows, but the market should now start to find resistance up towards some previous support turn resistance at 1993 and certainly ahead of psychological barriers at 2000 in favor of a lower top and the next major downside extension below 1808 and towards 1700 further down. At this point, only a close back above 2000 would compromise the newly adopted bearish outlook for the S&P 500. Gold. So gold remains highly constructive following the breakout above 1200, and with the market now consolidating above that previous psychological barrier, the risk is for additional upside towards a retest of the 2015 high from January at 1307. At this point, look for any setbacks to continue to be very well supported above 1190, while only a close back below that level would take the immediate pressure off the top side.